Japan's economy is a well-developed free market economy. It boasts of being the world's third largest nominal GDP and the fourth largest purchasing power parity or PPP. It has the second largest developed economy in the world. The country's per capita GDP in PPP was $40,193, according to the World Bank in 2020. Japan's GDP, measured in dollars, has tended to swing dramatically due to a fluctuating currency exchange rate. It all looks great on the surface, but this economy might be staring down the barrel of an economic crisis, especially due to its currency. Want to find out what has gone wrong and why there could yen be in a crisis? Watch this video till the end to understand. The yen, which is the currency of Japan, has now hit a low, which is the worst in the last 2.5 decades. Why is such a secure economy now facing these choppy waters? Well, this video is gonna explain just the same. In terms of the economy, Japan is currently fighting a two-fronted war. On the one hand, there's the matter of their currency, the yen, which is currently getting devalued rapidly. The value of the Japanese yen against the dollar has dropped by a fifth. It's a significant difference considering the yen is one of the world's most important currencies. Indeed, for the first time since the lost decades, alarm bells have begun to ring for Japan's economy. This has been the case since mid-2012, when the yen's value against the dollar reached a new record high. Ever since, the yen has lost 40% of its value from the time the record was set. On the other hand, Japan has been actively engaged in yield curve control, which is a type of economic control. The control is direct rather than the customary hidden or implicit curve control exercised by central banks like the Federal Reserve in the United States. The Bank of Japan is attempting to keep the yield on its bonds at zero. There is undoubtedly a range, implying that they are fighting free market forces in the market. The yield has been bumping up against the range's top limit. A fight is raging that is driving their economic policy in two opposing directions. After many misgivings, hesitations, and a delayed start, the market now appears to be entirely convinced that the Federal Reserve will tighten its monetary policy most aggressively in decades in 2022. With such a high rate of inflation, all forecasts, at least in the United States, appear to rise. On the other hand, things appear to be very different in Japan. The Bank of Japan issued a statement stating that it will employ all available tools to keep the yield on 10-year Japanese government bonds at 0.25% indefinitely. In comparison, May 2022 saw the yield on a U.S. government bond surpass 3% for the first time. How does the central bank set a cap on the yields on government bonds? By using new money to purchase enormous sums of government debt. This is commonly referred to as printing money, and it is already excessive. Many investors and savers now began to liquidate their yen and change them to dollars after the announcement. Their goal was to secure their savings while also attempting to increase their return. The 0.25% interest on Japanese government bonds is insignificant when compared to the 12 times higher yield on U.S. bonds. According to data from the Organization for Economic Cooperation and Development, this has caused a response which has caused the yen to be devalued to levels not seen in the last 30 years. However, just because it is discounted does not mean that its value has reached a nadir. The massive monetary policies between the U.S. and Japan may end up driving the Japanese currency even lower. The question, therefore, becomes, why is Japan's government so intent on managing the yield curve? After all, this is an ultra-expansionary monetary policy that is being pushed even further by Bank of Japan policies. Its objectives could include rescuing the Japanese government and making it simpler for it to continue spending without raising taxes. Japan has a nominal government debt of 240% of GDP. As a result, a 1% or 1.5% increase in government debt may cost the Japanese government nearly $120 billion per year in interest payments alone. Then, this isn't the primary cause. The truth is that the Tokyoto hierarchy has arrived at a single conclusion for several years. Only exports can keep Japan's economy afloat. They also believe that a weaker yen is required to sustain their increasing competitiveness and, more importantly, to keep Japanese products affordable on worldwide markets. On the other hand, we must not forget that one of Japan's central bank's key goals is to increase inflation. Japan has been dealing with a decline in the working population as a result of population aging. As a result, prices are being pushed down. As a result, the central bank wants to use additional monetary injections to support the export sector and encourage both investment and consumption through loans. The goals are clear and defined, but the end outcome is frequently a very different picture. As many experts have pointed out, this policy might be disastrous. Japan's average monthly trade deficit was $1.2 billion in 2021. Indeed, even though the yen has lost 40% of its value against the dollar since 2012, the external balance has become unfavorable. Japan's exports account for roughly 17.5% of its GDP, which is more than the US but lower than countries like Canada and the United Kingdom, where exports account for a quarter of their GDP. This does not take into consideration Germany's export powerhouse, where exports account for 47% of GDP. Over 3 times Japan's. Even though we associate Japan's economic success with its exports, research reveals that the country's export sector is not as specialized. While it is an economy that is heavily reliant on the import of various basic resources, when you add in the rising cost of energy, food, and minerals, as well as the dropping value of the yen, you have a recipe for a severe economic shock. Imports are increasing at a higher rate than exports. If things keep going this way, the Japanese people's purchasing power will be severely harmed. A recent Reuters poll revealed that Japanese businesses are becoming increasingly anxious that the weakening yen may harm consumption and capital investment. To make matters worse, the global economic slowdown, notably the impact of China's zero-COVID policy, may cause Japanese exports to suffer. Because China is Japan's primary export destination, more than 20% of its products are sent to China. The truth is that if this slowdown occurs, the Japanese economy will be left with a big hole in its external sector, which would contribute to the yen's continued depreciation. If this occurs, the yen would fall in value, as will Japanese consumers' purchasing power. This isn't the only ramification of this chain of events. The yen's depreciation might prompt other competing economies in the area to follow suit, resulting in a huge devaluation war amongst Asia's biggest exporters. After all, if one country's currency is depreciated in the near term, it makes the other countries less competitive. In this instance, purchasing items from Japan is less expensive than purchasing things from South Korea, for example, because the yen is presently less expensive than the won. China has already begun to depreciate its currency against the dollar in reaction to the yen's decline. Of course, a devaluation war is not in anyone's best interests. Yes, as buyer countries, the United States and Europe may profit briefly. The resulting imbalances might therefore lead to increased expenses in the long term. Beginning in July 1997, the Asian financial crisis seized most of East Asia and Southeast Asia, raising worries of a worldwide economic disaster owing to financial contagion. However, in 1998 to 1999, the recovery was quick and fears of a meltdown faded. The financial collapse of the Thai baht began the crisis on July 2nd, after the Thai government was obliged to float the baht owing to a lack of foreign cash to sustain its currency peg to the US dollar. Almost soon, the capital flight began, setting off a worldwide chain reaction. Thailand was in the midst of a foreign debt crisis at the time. As the crisis escalated, most of Southeast Asia, and later South Korea and Japan, suffered depreciated stock markets and other asset values, as well as a sharp increase in individual debt. The countries most hit by the crisis were South Korea, Indonesia, and Thailand. The collapse also hit Hong Kong, Laos, Malaysia, and the Philippines. Brunei, mainland China, Singapore, Taiwan, and Vietnam were less impacted, although all of them saw a drop in demand and confidence across the region. Japan was also impacted, but to a lesser extent. In the 4 major Association of Southeast Asian Nations, or ASEAN countries, foreign debt to GDP ratios climbed from 100% to 167% in 1993 to 96, then soared to over 180% during the height of the crisis. The ratios in South Korea increased from 13% to 21%, then to 40%, whereas the other northern recently industrialized countries performed far better. The debt service to exports ratios increased only within Thailand and South Korea. Of course, if anyone predicts that such an event will repeat, then it is a conclusion which is too far and too quickly made. We need to wait and watch how stubborn the Bank of Japan remains on its yield curve control policies. Also, how quickly, if the structural changes are made, will yen come back to a far better position, and if it will resolve the operational flaws in the traditional Japanese economy. Maybe it can start by taking in some foreign direct investment. Well, that is it, folks, from our side for this video. We hope you are now clear as to why the yen is falling and the impact it might have on the market. Make sure that the economy of our channel stays afloat. Please do like the video, and it is completely free to do so. So go ahead, PLS, give a thumbs up and subscribe for more videos. It would mean much to us, and it also encourages us to produce more valuable content for you all. If you have a specific topic you'd like to learn, PLS, leave us a comment below, and we'll work on it for you. Until next time, sayonara.